Looking for big sales in this stock market? Like the idea of collecting safe, growing, totally passive dividend income? Want to know about stocks that are 20%, 30%, 40% off of their respective 52-week highs? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, if you want exclusive access to my personal six-figure stock portfolio and alerts on any new investments I make, check out the Patreon link in the description below. The US stock market is cruising along near all-time highs. It's a market of stocks, not a stock market. The market isn't a monolith. There are thousands of individual stocks that make up the entire US stock market. And many of these individual stocks are down significantly from their recent highs. Better yet, some of these stocks are dividend growth stocks. That's my bread and butter. I invest solely in high-quality stocks that pay reliable dividends. What better way to prove your growing profit to your shareholders than to send them regular proof of that via growing dividends? And what better form of passive income than growing cash dividends from world-class businesses? Today, I want to tell you about 5 dividend growth stocks that are down at least 20% from 52-week highs. Let's dig in. The first dividend growth stock I have to tell you about is Amgen Inc., stock ticker AMGN. Amgen is a global biotechnology company with a market cap of $118 billion. This is one of the world's biggest and best pharmaceutical companies. Everything about their fundamentals scream quality. They operate at a high level across the board. That includes their commitment to paying out a reliable rising dividend to shareholders. Amgen has increased its dividend for 11 consecutive years. And I think that's just the start of much more to come. Amgen will likely one day sport a multi-decade track record of consistently rising dividends. The 5-year dividend growth rate is 15.2%. And with that double-digit dividend growth comes a very appealing yield of 3.4%. Also, free cash flow covers the dividend more than twice over. This dividend offers a lot to like. You know what else is likable? The markdown on the stock. This high-quality dividend growth stock is down 25% from its 52-week high. It's currently priced at $207.84 a share, which pales in comparison to the 52-week high of $276.69. In my view, this is quality merchandise on sale. I analyzed and valued Amgen back in late June, showing why shares could be worth a bit over $262 each. So we could be looking at quite a bit of upside here. And while you wait for that upside to materialize, you're collecting a market-beating 3.4% yield here. Next up, let's talk about Cardinal Health Inc., stock ticker CAH. Cardinal Health is a healthcare products distribution company with a market cap of $14 billion. Cardinal Health isn't a household name, but it's actually one of the biggest companies in the United States by revenue. We're talking annual revenue of over $160 billion here. But because the margins are razor thin, think net margin below 1%, the sales multiple is very low. As a middleman distributor, you just don't get huge margins. Still, Cardinal Health does pay out a reliable rising dividend to shareholders. The company has increased its dividend for 25 consecutive years. Yep, that makes them a dividend aristocrat. Now, recent dividend raises have been modest. The most recent dividend increase was only 1%. That's because earnings growth has been challenged. On the flip side, the stock yields a market-smashing 4%. There aren't many dividend aristocrats yielding over 4% right now, so that is notable. And free cash flow covers the dividend 3 times over. If all of that isn't piquing your interest, maybe the pullback will. This stock is 23% off of its 52-week high. The 52-week high of $62.96 was reached back in the spring, but it's a different world now, and shares are now trading hands for $48.54 each. Now, I will say that I personally sold out of Cardinal Health back in April when it was slightly over $61 a share, and I alerted my patrons about that move in real time. I just felt like the valuation and yield didn't make sense with the lackluster growth at the time, but after falling pretty significantly since then, it's definitely more interesting than it was when I sold it. The price to cash flow ratio of 5.9 is well off of its own 5-year average of of 8.6. If you're looking for a 4% yielding dividend aristocrat that's nearly 25% off of its 52-week high, Cardinal Health should be on your radar. The third dividend growth stock I want to highlight is HP Inc., stock ticker HPQ. HP is a multinational information technology company with a market cap of $33 billion. As one of the world's largest computer manufacturers, HP prospers. After all, we're in a world in which people are more reliant than ever on computers. It's a very competitive and challenging industry though. That said, HP continues to manage through it well and pay out a large growing dividend. They've increased their dividend for 11 consecutive years. And unlike Cardinal Health, HP is growing its dividend at a blistering rate. The 10-year dividend growth rate is 16.7%. Even the most recent dividend increase was 10%. Now, it doesn't offer the yield that Cardinal Health does. HP stock yields 2.7%, but that does beat the S&P 500's yield twice over. And it's paired with double-digit long-term dividend growth. Also, the dividend looks safe here with a payout ratio of only 24.1%. Making things perhaps even more compelling is the way in which this stock has really pulled back, bringing the valuation down. This stock is down 21% from its 52-week high. You can almost think of the stock market like an ocean. People only pay attention to the surface, and the surface looks great with the S&P 500, for instance, very close to its 52-week high. However, it's the undercurrents you have to look at. Under the smooth sheen of the surface is a lot of volatility. This stock is a great example of that. Its 52-week high is $36. Shares are now priced at $28.28 each. Every basic valuation metric I look at is below its respective recent historical average. If you're looking for a nice yield in the IT space, along with a sizable pullback, HP is definitely worth considering. Let's now discuss Medifast Inc., stock ticker MED. Medifast is an American weight loss and nutrition company with a market cap of $2 billion. We're now in the small cap space here, but small isn't necessarily bad. In fact, it's quite often the opposite. Many small businesses naturally grow much faster than large businesses. Indeed, Medifast nearly doubled its revenue in the last 2 years alone. Earnings per share is up more than sixfold over the last decade. With that strong business growth, it shouldn't be surprising to see strong dividend growth. This company has increased its dividend for 6 consecutive years. A young dividend growth streak, sure, but it does look promising. The 3-year dividend growth rate is a very impressive 52.3%. That huge dividend growth has partly given rise to the 3% yield the stock now offers. Now, I wouldn't expect that kind of dividend growth to persist forever. However, even the most recent dividend increase, which was announced back in March, came in at 25.7%. And even with all of that monstrous dividend growth, free cash flow still covers the dividend almost twice over. If that doesn't entice you, maybe this will. The stock has fallen 43% from its 52-week high. Wow, this thing has fallen off a cliff. Since reaching its 52-week high of $336.99 back in May, it's been almost a straight line down. Shares are now priced at $190.90 each. You've got a feel for those who were paying over $300 a share for this name only a few months ago, but their pain might be your gain. The valuation has become much more reasonable here. The price to cash flow ratio of 15.4 is significantly lower than its 5-year average of 22.2. This company is involved in multi-level marketing, so keep that in mind. But if you're fishing for a small cap dividend growth stock that's more than 40% off of its recent high, this name might be worth snagging. Take a good look at it. Last but not least, I have to highlight South Jersey Industries Inc., stock ticker SJI. South Jersey Industries is a natural gas utility company with a market cap of $2.5 billion. We're right on the edge of another small cap name here, but whereas Medifast is somewhat of a new kid on the block in terms of corporate history and the dividend growth track record, South Jersey Industries dates back to the turn of the last century, and they've been growing their dividend for decades. This company has increased its dividend for 22 consecutive years. Now, the company isn't lighting the world on fire here with the dividend raises. The 5-year dividend growth rate is only 3.4%, and the most recent dividend increase was only 2.5%. This is because earnings growth has been almost non-existent over the last decade. However, what the company lacks in dividend growth, they more than make up for in terms of yield. The stock's yield is a mouth-watering 5.5%. But with the dividend sucking up 75.6% of this year's midpoint guidance for adjusted earnings earnings per share, I wouldn't expect any kind of dividend growth acceleration for the foreseeable future. It's your classic income play here. Maybe it's an upside play too. The stock is 25% off of its 52-week high. South Jersey Industries reached its 52-week high of $29.24 in March of this year. Then it all came apart with a stock offering and middling earnings results, sending the stock into a downward spiral. This name is now at just $22.05 a share. The thing is, I almost always use short-term volatility as a long-term opportunity. South Jersey Industries might not be the highest quality or most exciting business out there, but this 25% drop could be your long-term opportunity. The stock's 5.5% yield isn't just nice compared to the S&P 500, it's 150 basis points higher than its own 5-year average. And the price to cash flow ratio of 6.6 is less than half that of its own 5-year average of 14.0. If you're searching for a natural gas utility business yielding 5.5% after a dramatic drop, South Jersey Industries might just be it. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about these 5 dividend growth stocks that have pulled back. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It'll allow me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.